More aggressive talk from the Federal Reserve has futures on shaky ground this morning. This is what you need to know before the bell. Last week, James Bullard and Loretta Mester both said that the Fed is going to continue to hike rates more aggressively. And in fact, James Bullard said, hey, don't be surprised if we hike by 50 basis points at the next March meeting. Well, that certainly undermined the stock market's view of a one-and-done hike in February. Now, all of a sudden, interest rates back on the move. Fed fund futures now up 40 basis points since just 2 weeks ago, suggesting a 5.3% terminal rate for the Fed, much higher than what the markets were predicting earlier, as well as the fact that, well, those rate cuts expected in June and July, those may not be coming as the Fed continues to hike rates into the middle of this year on concerns that inflation remains a lot more sticky than most people imagine. Of course, after the recent employment report, the retail sales report, etc., all suggest that the economy is actually doing pretty well here, despite seasonal adjustments. But that is an underpinning for that inflationary pressure. Of course, the Fed's big concern is a resurgence of inflation akin to what we saw in the 1970s. These concerns overall undermine two things for the bulls' narratives. First of all, the market has been rallying since October on this expectation the Fed would pivot and then start to cut rates as soon as June or July of this year. Now markets are having to start to deal with this idea of higher rates for longer, which will undermine both corporate earnings and profit margins. This is one of the big concerns, of course, going forward. Valuations are still elevated here as prices have been rallying while earnings have been falling. And of course, this idea of a soft landing in the economy becomes much more problematic if the Fed continues to hike interest rates more aggressively. As such, on Friday, the market did crack below the 20-day moving average to this morning. Futures are pointing lower. The Dow's down over 300 points this morning, along with the NASDAQ and the S&P, suggesting that we are now going to go into a process of retesting this 50-day moving average, which has crossed above the 200-day moving average, so that's a bullish indicator. But this level of support right around 4,000 is now key for the markets to test and hold here over the next few days. Pay attention to what's happening in the markets here. Over the last week or so, this consolidation of prices, market's not been going anywhere, has triggered our sell signal. That does suggest lower prices in the near term. So holding a little bit more cash right now. Be careful jumping into equities here. There's likely going to be some lower prices ahead as a better buying opportunity. Just keep a watch on the markets here over the next few days. We'll keep you updated. I'm your host, Lance Roberts, and that's what you need to know before the bell.